Well, that's certainly not good. While Kathy Wood is optimistic about the tech disruptors and innovators, and she thinks that shareholders will be handsomely rewarded in the years ahead, she is concerned about talks of a recession within the next few months. I'll talk about this and more in this video. If this is your first time tuning in, my name is Daniel, and you're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. If this is your first time tuning in full disclosure, this is not financial advice. And at the time of this video publication, I did not own any stock or any interest in any of the ARK financial products. So earlier today, Kathy Wood went on a tweet storm calling out several important points. Let me summarize them here. Combined with the fear of supply chain bottlenecks and enabled by government-provided fiscal stimulus, businesses and consumers have recently overreacted, that's her words, and loaded up on inventories at the fastest pace in several decades. While this may not seem like a concern, she also called out how this very build in inventories was actually the only real contributor to economic expansion recently, as consumption was effectively flat year over year. I personally don't agree with Kathy Wood's assessment that this was an overreaction, as I'd argue in addition to bottleneck fears and stimulus, a lot of this behavior is actually from purchasers who are legitimately worried about their buying power and would rather load up before facing the impact of potentially even higher inflation in the months ahead. I mean, if you have been impacted by higher priced goods recently, I think you know what I'm talking about. I'd love to hear your comments below. Even worse, as she calls out, it appears that consumer sentiment is in the doghouse, dropping to lows lower than what you saw at the start of COVID during the real pandemic, and at levels historically associated with recession. You can see this chart here going back to the last several decades. This actually has the potential to be a really big deal because consumer purchases are the vast majority of the U.S. economy. Kathy Wood even calls out how she thinks fears of inflation will be replaced with fears of recession within the next 3 to 6 months. So within a few months from now, the talk of recession could be the main focus for investors versus inflation, and arguably that could lead to a reset in the markets, just that concern. But this does make sense. I mean, look, if lousy consumer sentiment translates into a glum purchasing outlook, there's few sectors that won't get hurt and even fewer that can potentially benefit. Despite this dour outlook, Wood does see a ray of light in this potential darkness, where she views the current investment landscape as the flip side, using her word, of Y2K, or the year 2000. Where in the dot-com crash, cheap legacy companies prospered in the ensuing years, and the new dot-com high flyers crashed and burned. Now she thinks the flip of this will occur as fast-growing innovators and disruptors unseat the expensive legacy businesses. She calls out how many of their equities maligned this year, aka they're down, should be rewarded handsomely, which fits into her prior commentary just in the last few weeks, thinking that the ARK funds can go up several 100% within the next few years. What's my personal take? First, a quick plug, where if you're interested in following along with my personal financial journey, go to unrivaledinvesting.com, where each month I call out potential multi-baggers as well as my personal portfolio. We also have an exclusive community dedicated to learning and trying to find exceptional companies on Discord. So if you're interested, go to unrivaledinvesting.com, click join the journey. And if you enjoy videos like this, please make a point of hitting that subscribe button and hit that thumbs up button. And so first, let's see what the market thinks, because there's often some signal in the price action. So if we look at 2021, many of the ARK ETFs are down, while perceived legacy conglomerates like Berkshire Hathaway actually posted a banner year where Berkshire Hathaway stock was up something like 30%. So that is one data point effectively saying the market saying, yeah, these legacy companies seem to be doing fine or doing well. Maybe that will change in the coming months. Further, I'd argue that if lousy consumer sentiment is potentially leading calls for a recession in the next 3 to 6 months, like she's called out, it's hard to see why a lot of businesses will do well, including the tech innovators, I'd say. Sure, some of them have structural tailwinds, and that's what she's loading up on, and are these companies that she thinks have multi-year, multi-decade tailwinds, but it's definitely harder to accelerate sales of, let's say, a $50,000 Model 3 if consumers start tightening their purses. Tesla is the top holding for the ARKK, ARKW, and our ARKQ ETF. So that's the largest holding. And I'm like, how are they going to further accelerate their business if consumers might start saying, hey, times are getting a little tougher. Can we really splurge on a $50,000 EV? This weakness in consumer sentiment also comes at a terrible time as the Federal Reserve is now facing the tough task of tightening up liquidity. As I've called out in this prior video about saving yourself, this can have a dramatic effect on valuation multiples for many of these growth stocks in the years ahead, unless they also have a very solid free cash flow to back up their prices. Because if you have a period where the Fed effectively starts soaking up all that liquidity, valuation multiples can start coming down. And so you need to have sort of a hard backstop of, hey, there's this dramatic free cash flow that can sort of back up that valuation. Or, I'd say the other approach to consider is if you're going to be buying these high growth companies where they may not have those free cash flows, it's really important that you have really attractive growth, even assuming a conservative scenario, even assuming, let's say, slower growth, you can still pencil out, let's say, 50% plus growth in the years ahead in the low side, and pencil out on the high side several 100%, 300, 500% type upside. And that's personally what I'm looking for with the multi-baggers that I call out to Unrivaled Investing Journey subscribers each month. So what are your thoughts on this latest development? Cathie Wood going on this tweet storm, talking about how she thinks these innovators and tech disruptors will do well, but the fact of this clear risk of consumer sentiment weakening, arguably the danger zone for consumer behavior and potential recession, and the prospect that those companies will do well even facing the prospects of a recession. What are your thoughts? I'd love to hear it. Please leave a comment, and if you enjoyed this video, please make a point of hitting that subscribe and thumbs up button. Thanks for tuning in.